Welcome to a world where business is transformed and money is produced. We are discussing the fascinating and frequently misunderstood industry of private equity. This term may just look like jargon to a lot of folks. But today, as you learn more about the definition, uses, and effects of private equity on the financial and economic domains, we're going to take you on an exciting adventure to unravel its secret. Are you prepared to learn the untold tales of private equity? Now let's move forward. More billionaires have been created by private equity internationally than by oil and technology combined, with a $4.7 trillion market value. It has, however, also drawn criticism for acquiring well-known companies and raising housing expenses. Despite this, it continues to rank among the top career objectives. The private equity firm Hill Path Capital has acquired all of SeaWorld's outstanding shares in an attempt to dissolve the company. Private equity firms have also purchased medical facilities and physician practices. Venture capital firms make investments in startup businesses to support their growth and customer acquisition. In order to provide asset liquidity, other private equity firms purchase alternative assets. Buyout funds buy entire companies and make enormous profits. Those who want to launch one must follow these three important steps. The legal framework of your company is essential to you as a private equity fund manager, and it must be established well before you enter the market in order to attract your first investor or acquisition opportunity. The first step in managing the intricate financial requirements while lowering personal risk and maximizing personal benefit is to get your organization structure right. The smart move in this case is to establish a Delaware limited partnership in which you will serve as the general partner. Because of its advantages in terms of both legislation and operation, the Delaware limited partnership is a preferred option among private equity firms. You will have the authority to oversee daily operations and make important investment choices as the general partner, but you must carefully consider the Limited Partner Agreement, LPA, before forming the partnership. The Limited Partnership Agreement, LPA, is a legal contract that outlines the terms of your investment plans, profit distributions, and loss allocations between you, the general partner, and your investors, who are the limited partners. It's the guide that governs collaboration, guaranteeing structure and clarity in your interactions with investors. As general partner, the LPA outlines your responsibilities and limits of authority while giving you the ability to direct the fund's investments. Both general and limited partners can feel secure and stable under this arrangement thanks to its clearly defined LPA. It's critical to avoid having too little authority to operate the fund effectively or too much control, which could frighten off investors when putting this structure in place. To manage a private equity fund effectively, this balance is essential. Yet that's not all. You'll also require a management company that functions independently of the business, yet advises the fund and the companies it has acquired. Business analysts with a Harvard MBA are employed by the management organization to offer advice, fact-based assessments, and due diligence concerning a company's investment prospects. You or a reliable partner should be appointed as chairman and CEO. After the legal structure is in place, the next step is to start hunting for investors and popular, profitable companies to aggressively pursue. Due diligence is the process private equity firms take before buying a company. It involves finding inefficiencies, recognizing subjective components of a business model, and figuring out where they might be able to add value. Their goal when they take over the company is to make a profit and get out of the market in 5 to 7 years, usually by selling the company or going public. They plan to use a combination of loans and equity to finance the purchase. Private equity firms act as intermediaries between investors and private enterprises, enhancing investment returns. They obtain funding from investors and utilize it to make investments in private businesses. The CEO of a private equity firm bears the burden of convincing investors that the company can still yield higher returns than its competitors, even after deducting costs. Businesses receive 20% of all returns above a threshold rate and 2% of all assets under management annually. There are therefore great incentives to generate substantial returns. Investing a portion of the company's cash into the fund creates a tax shelter and establishes the fund manager's legitimacy, which are the initial steps in attracting investors. In addition to their consistently high returns, investors are attracted in part by their contacts and business experience. Experienced private equity managers who have worked in the hotel industry in the past, for instance, could start a specialty firm that only makes investments in hotels and related businesses. When it comes to acquisitions, analysts work with investment bankers to find businesses that are profitable and have good cash flow, which the private equity firm can improve through upgrades. Because investing in a firm beyond what investors agreed to could result in lawsuits for breaking the terms of the limited partner agreement, it's imperative that you stay within your areas of competency. When financing projects, private equity teams seek loans from investment banks since they know that if the fund has steady profitability and robust operating cash flow, it can quickly repay the loan. After that, the business can go through a leverage buyout, where a bank loan is used to buy the company by a private equity firm utilizing its money. The objective is to increase the amount of assets under management while obtaining for investors the maximum amount of value from the acquired portfolio companies. Private equity funds can fire CEOs and replace the team if the assigned management group fails to live up to expectations. The objective is to keep the business profitable and stable while simultaneously streamlining its processes. The ultimate goal of a private equity firm managing a growing portfolio of assets is to optimize investor returns. Sifting through potential investments is the third step for a private equity fund manager. To achieve successful investment outcomes, this step, which comes after funding, raising, and setting up the legal framework, is crucial. Potential investments must first be carefully investigated by a private equity fund management. This means doing as much research as you can on the company's operations, management, competitive landscape, financial results, and growth potential. This information is gathered through a variety of research methods, such as reading through reports and open filings, speaking with industry insiders, and conducting interviews with the company's management. After obtaining this information, the private equity fund management can assess the potential investment opportunity. This means weighing the benefits and risks of the investment while keeping the company's financial stability, competitive landscape, and opportunities for growth and development in mind. Furthermore, the management of the fund must evaluate the potential return on investment and determine whether it aligns with the fund's overall investment strategy. If a possible opportunity is accepted and aligns with the firm's strategy, the management of the private equity fund can make an informed investment choice. Making this decision typically means finalizing the deal and going over the investment's terms. But the work of a private equity fund manager doesn't end there. After an investment is made, the fund manager's work is not finished. They still need to actively manage the portfolio and take smart actions to boost its value. This means working closely with the company's management team to identify issue areas and implement the necessary changes to promote development and profitability. Providing the company with increased capital to support expansion or strategic goals is another facet of active management. The management of the private equity fund may periodically attempt to sell the investment or list the company publicly in order to maximize returns for fund investors. We hope you find this educational tour on private equity informative, and we appreciate your patience. You now know what private equity is, how it works, and what it can do. Because private equity fosters job creation and corporate expansion, it plays a major role in our economy. With any luck, this video has served to shed some light on some of the most important aspects of this intriguing and powerful industry. We appreciate your time. Kindly subscribe to our channel, like it, and share it.